The American author Mark Twain once said that I've lived through some terrible things in my life, some of which actually happened. I think that's an interesting quote to keep in mind, especially now, as everyone is imagining what could happen, what terrible things might be ahead of us in 2025. And I wonder if what we may be surprised by as we go into a new year is how non-terrible some things may be. We always love to imagine the apocalypse as human beings. I don't know why, but that is something that we do. And we cower in fear about what could happen, as opposed to taking steps and creating something lovely that will happen.
You are listening to the AFIRE podcast, real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
And today we're speaking with Rebecca Rockey, who is the Deputy Chief Economist and Global Head of Forecasting for Cushman Wakefield. So, of course, I want to talk to the Global Head of Forecasting to think about what's going to surprise us in 2025. A lot of the conversation right now at the end of 2024 has been centered around political changes and geopolitical shifts. And what is the Trump administration going to do or not going to do when it comes to everything from tariffs to regulations to restructuring banking system, et cetera, et cetera, et cetera. It just goes on and on. How much of an impact, Rebecca, do you think we should be looking at as we're trying to figure out what are we going to be surprised by in 25? It seems like there's other forces in play as well. What do you think?
Well, I don't think we will have a shortage of surprises out of DC. We both live there, so we get to look forward to that. But I think there are forces in motion, if you will, that are going to play out next year regardless of what's happening in the policy environment. And it's specifically around the capital markets, which are a defining feature of this cycle for commercial real estate. We've clearly gone through some repricing. We've seen capital sources start to shift around in response to that. And as we move forward next year, those shifts in the capital sources are going to continue to play out. And I think some of those changes will be much more prolonged than just 2025.
So shifts in capital markets sounds mild, but it sounds like there's something deeper. Can you be specific? What do you think is going to happen or could happen in terms of the capital stack, who the players are, how we approach it that's going to be potentially different?
Yeah, I think I'm going to start with banks because they have been really the largest force in CRE debt markets
Right.
in the last cycle. So, for any listener who doesn't have all these stats right on hand, prior to the GFC, CMBS was roughly 75% or 75% in any given year of debt originations. And banks were just a small portion of that market at that time. Post GFC, banks took on, in any given year, especially over the last 6 or 7 years before the pandemic, and including through the pandemic, banks became 40 to 45% of all debt originations. And that was a majority. That was the largest player by far. And they're clearly going through what will be a challenging period for them as CRE distress continues to play out and, in fact, ratchets up next year. And I think that's going to be something we're all watching. We're already seeing those early signs. You get data from the FDIC, you see delinquency rates ticking up and so on. But in our business, what we see is things like note sales or credit risk transfers picking up. We see banks thinking about what the strategy is in terms of bringing in capital. Are we going to take things REO or are we going to try to sell them off into the marketplace as the inevitable of that distress cycle actually starts to play out? We've all been calling for it, but actually I think next year is when it starts to materialize. What that means for the shifts in broader capital markets is we're not going to get banks at 40 to 45%. Right now, they're around 30%. I would not be surprised if they sit in the 20 to 30% of market share and that we see different players, maybe some legacy players like family offices coming back in, been very active, especially at the smaller end of the transaction size of the market. But we're going to see more of the larger transaction portion of the market going into private credit, private equity, and more unregulated, more opaque portions of the market. And that I think will endure well beyond 2025.
And it does seem like we've been ginning up debt funds over the last couple of years, and there seems to be a lot of energy around that. And it seems like every major institution wants to have a debt fund or several debt funds in order to fill that vacuum to a certain extent. And I'm hearing, certainly, I can imagine right now that there's a lot of excited, opportunistic investors and developers that are going, finally, we're going to see some of those devaluation of some of these office properties that maybe we can come in on. So it sounds like you're saying that 25 perhaps is more likely that we're going to see a little bit more action in that area.
I think it's going to be two kinds of action too. So I would say we think of the capital market cycle as different from the distress cycle. Distress, we think, will pick up next year.
Mm.
That is going to be a function of how banks approach their loan books. You're going to have maturity related defaults, especially in the CMBS market. We're at over 10% on delinquency for office, as you know. I've heard people prognosticate, very well-respected strategists, we might go over 20% delinquency rates there. So I think, again, we're in early stages with this. Think of distress as right now it's about 3% of all transactions
Okay.
or some distress trade. Next year, I think we're going to probably get more in the 5 to 6% range. So that's going to be a function of the volume of it going up. But we also expect the capital markets broadly to start recovering. And so outside of distress, we think in most sectors, you're going to be near a bottom in pricing. You're going to see whatever it is, 95% of transactions happening that are not distressed trades,
Right.
that are actually experiencing some kind of appreciation from their implied trough. So we're going to see this kind of dual track play out.
Right.
It's not to say that there aren't maybe some minor spillovers here or there, but I would definitely think of distress as its own sort of entity as we head through the year and frankly into 2026 and even 2027, given just how the debt markets work and how long it takes for all of these loans to be recognized at their current value versus maybe what they were valued at when they were originated.
Well, even if history is our guide, if we look back to these kinds of transition periods historically, if you think about the early 90s, this isn't a year and then you're done. This is
Right.
3 to 4 to 5 years of moving through the system. But it sounds like there's more pressure, at least from the banks, to stop extending, to stop, holding back and waiting for a better day, to start acknowledging their losses on their books. Do you think there's going to be a lot more activity in 25 around that?
I do. I think my view is that it's just going to continue to ratchet up sequentially through the year. I think it's going to continue to ratchet up into 2026. We know based on really great research coming out of the regulators themselves that it is the more weakly capitalized banks that have been developing the most exposure.
Yeah.
And there is a lot of concern about continuing to play this game of extended pretend. And I do think you're going to get more pressure to actually bring these things to market. And that's going to be its own system of events. Of course, you have CMBS and a lot of loan maturity defaults that will continue to play out there. But again, that's just going to be a portion of the market.
Right.
I do think it's going to go from the low right now of about 3%, which frankly is sort of an average. It's not an unusual thing. So going up to 5, 6%, I wouldn't be surprised if at the peak, maybe 10% of trades were some form of distressed sale. I don't think that's going to happen next year, but I do think as that cycle plays out, that could be a percentage that we get to, but it will also be at the same time, right, when the level of the market is also rising. So you sold 90% that are not trading on distress.
Right.
So I think there are a lot of opportunities heading our way. This is going to create, as we've talked about in the past, opportunities for maybe reimagining certain things that
Right.
we shouldn't have anymore. That's a great creative destruction process that our industry is really, really good at. But it's been a while. So I think we need to go through that. And then I think we're going to see other shifts in the capital markets that play out again over time that are maybe also independent of who's actually funding commercial real estate transactions.
It appears that you're saying, and please correct me on this, that one of the surprises may be the pace of this. I think some people have been expecting a large market clearing to occur at some point, a rapid market clearing where, and whether we acknowledge it or not, there seems to be this thing sitting inside our hearts going, I want that to happen because then the deals are all going to happen quickly and I can get out of this mess. But what we may be then I guess, surprised by is the pace of this clearing, the pace of this change is not going to be rapid or all at once. It's going to evolve over time. Is that a correct restatement, if you will?
Absolutely. So I think there are two great historical analogs where you can look back and say, what really happened there. So one is the GFC. I mean, we're not having a financial crisis. And when you think about CRE debt versus the full financial system and the nature of what was happening in 2007 versus today, wildly different situations. And there just isn't that crisis driving at one, a recession, but then a financial crisis where you just have fire sales happening. Then you can go back to the SNL and think about the fact that technically that played out over 14 years. And it really came to a head in the early 90s when we also had a recession. So if you're in that soft landing camp and you don't think there's going to be a recession that drives significant declines in operating fundamentals, job losses, and ultimately, therefore, distress and delinquencies in the lending markets, if you're in that soft landing camp, which most are, we're generally in that camp as well, then you get the slow burn. And it's not a cliff event that everybody's expecting. Yes, it does ratchet up, but it's a slow process. And that's why we think it's going to continue into 2026 and probably 2027 to a certain degree, because it really just takes time.
Interesting. I think, so well said. And I think from the standpoint of saying maybe it's not about fearing a large, negative event, which I think a lot of people still instinctively are feeling, but let's muddle through. Let's figure out how to work through the burn, if you will, and somehow kind of work through it. There's going to be a lot of noise, but our job perhaps is to stop listening to the noise and focus on our work and our knitting and finding those spots, those opportunities, and being careful of the risk, just like we always should be. Well, we've been speaking with Rebecca Rockey, of course, the Deputy Chief Economist and Global Head of Forecasting for Cushman Wakefield. Good luck in 2025. And thank you so much, Rebecca, for joining us on the AFIRE podcast.
It's a pleasure. Thanks for having me.
You have been listening to the AFIRE podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. AFIRE is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though AFIRE is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of AFIRE.